Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate it, really do. This channel is dedicated to the rational, cash flow hungry investor. And this week up, we're going to take a look at Netflix, the absolute behemoth in the online content delivery space. Let's take a look. The stock is down recently. Let's figure out how much cash these guys generate, what we think they're going to do in the future, and if we bought it today, how much can we earn by buying the stock and holding it for the next decade? You ready? Let's get to work. The very first thing you should do when you're looking at an investment is to read the 10K. 10K is the annual report every company must file with the SEC. And I highly recommend you read that for any stock you're invested in every single year. Now, at this channel, we focus on the cash flow statement, in particular on that 10K, because we want to know what the cash value of the business is, and that forecast is what underlines the value of the business going forward. Now, you're not going to see any fancy green or red lines in this chart. You're not going to see bulls or bears go dancing across the screen. That's not what we do. We are cash flow hungry investors. That's what we want to find. That's what we're going to value. And I use a 5 key attributes method for considering an investment. Number one, we need to see top line revenue growth. It must be growing top line. Number two, earnings. Earnings, we look at enterprise level earnings, which is EBITDA. Number three, I want strong free cash flow. Number four, low debt, that's less than 3 times debt to EBITDA. And number five, I want a stock that's well priced. A well priced stock is a stock which, if I bought it today, based on a conservative forecast to the future, would produce an expected return that I would beat the market over the next 10 years. That is a well-priced stock. Now, does that mean every stock that's well-priced you need to buy? No. You pick the very best and you use other intangible metrics like management team, market demographic, other things that competitive landscape that you can use to judge that business. We'll get into all of that. But that's the basics, the 5 key attributes that we're going to cover here on this channel. All right, let's dive right into Netflix. Behind me, I have 9 years of financial data for Netflix in USD in millions. Their fiscal year ends December, so I've got the most recent 2021 numbers sitting in here. 2013, they made $4.4 billion of top-line revenue. And that revenue has grown every single year since then, which is a phenomenal track record to have a company that can every year produce higher and higher revenue. On average, as an annual growth rate, a consolidated annual growth rate, they've grown their revenue 27% annually every single year. That's amazing. Most recent year, $29.7 billion, just shy of $30 billion of top-line revenue. That absolutely checks our box for us. It's a growing company. I can't say it's not. Let's keep going. We're going to dive in a little further later. Profitability. Now, we use EBITDA. EBITDA is earnings before interest, tax, depreciation, and amortization. And in this case, there's a little bit of caveat because Netflix treats their content differently than I would like them to do. What they do is they capitalize the expense of all of their content and put it on the balance sheet. And then they stretch that expense over the useful life of that content. For example, if they make a show, they've got producers, actors, video camera rentals, set design, food carts, clothing, makeup, all this stuff, the salaries for the people that do all this stuff. Well, they add it all up in one giant number, and they put it on the balance sheet as, hey, I made this movie, TV series, it has value, and I'm gonna license it to people, let people watch it over the next so many years. So I'm gonna take that expense, and rather than hitting the P&L with it all this year, I'm going to stretch it out over time. And that's typically what people do, or what companies do with large pieces of equipment, like farm machinery, buildings, or whatnot. It's going to generate income for multiple years, and you amortize it out. Well, Netflix does the same thing with their content. And so the technical definition of EBITDA, earnings before interest, tax, depreciation, and amortization, means you would add that amortized expense for content back. Now, I have not done that here. I've expensed that content, that amortization, and I'm only adding back the depreciation of their property, plant, and equipment, which is much less. And we'll get into this a little bit later, but I wanted to make that caveat. So their EBITDA, which is enterprise level earnings, not earnings per share, enterprise level earnings, has grown from $277 million to $6.4 billion annually, which is tremendous growth. On a consolidated basis, it's 48% annualized growth rate, which is really strong for this business. All right, so we got earnings growth, we've got enterprise level growth of earnings, and actually earnings are growing faster than revenue, so the margins are growing, which is good to see. The next thing we need to do is we need to calculate the enterprise value of Netflix. Now, what is the enterprise value? Enterprise value is the entire value of the business, both equity and debt. You want to add them all up so you can look at a business relative to other businesses on a same level basis. Businesses can affect their value by how much debt they have. If you only look at the equity, then you're missing a giant piece of their business, which is the debt. So what we do is we start with the amount of debt, the most short-term and long-term debt that they have on their balance sheet. And that's grown from $500 million to $17 to $18 billion of debt over these 9 years. Now, they've also accumulated excess cash in the balance sheet, and we're going to net these two for kind of a net debt figure. But we're going to take that, we're going to add it to the market cap. The market cap is the amount of stock that they have outstanding times the price you see in the stock market. I use December average because it's closest to the fiscal year when they release these financials. So $22 billion to $274 billion. That's a 10x of value on the market cap. Really, really big growth. So I add the debt less the cash plus the equity, and I get enterprise value, $22 billion to $287 billion. Now I'm going to define enterprise value for very, very quickly. Think of a house that you might buy for, say, $1 million. That's the market value for the house or its enterprise value. Now, you could either A, come out of pocket all cash and buy the house for $1 million. Okay, in that instance, debt here is zero and market cap equals enterprise value because you paid cash for it. Or you go to the bank and say, hey, give me $800,000. I'll put $200,000 down of cash to buy the house. The house is still worth $1 million. That's still here. You're just splitting how you finance the business, how much cash you have to come out of pocket. Same thing with the stock. The market cap is the cash down payment you make on a house. The debt is the mortgage. So there is a difference between a company that is debt-free versus a company that's fully levered. Those are two different, and you want to normalize that. The only way to do that is to focus on the enterprise value. All right, let's keep going. Now, once we have the enterprise value, what would we do? We want to look at payback ratio and we want to look at a debt ratio. So we're going to do two things. Let's focus on the debt first. Debt has gone from 0 to 2 times. This is taking the amount of debt, the net debt they have. So 17 billion minus 18 billion minus 4.5, call it another 14 billion. Divide that by how much money they make annually of 6.4 billion, and you get 2.1 times. That means Netflix has to operate for 2 years and take all of their earnings to pay off debt if they got in trouble and had to pay down the debt immediately. We use 3 times as a ceiling for how much debt we like to see in a business. This is less than that, so it checks the box. Good job, Netflix. Now, enterprise value to EBITDA. This is the multiple you're going to pay on an enterprise level, kind of like earnings per share, EPS. Or a PE ratio, a price per earnings ratio. A PE ratio is similar to an enterprise value to EBITDA. This is just up at the enterprise level. So it's gone from 80 times, which means at $22 billion of valuation with earnings of $277 million, it would take 80 years of operating for this business to generate the cash to justify the value or the payback value of enterprise. Now, no one is going to buy Netflix because they think, well, I'm going to wait 80 years to get my money. No, they were expecting growth and they got it. So they paid a high multiple. The earnings grew, so it paid itself back much faster. In fact, let's take a look. They need to justify $80 billion. They need to justify a $22 billion valuation through earnings. So did they get there? What is that sum? That sum is $17 billion. So in 9 years, the business has earned almost as much as the enterprise value back then. So It was valued back then an 80 times multiple. In reality, with earnings growth, it turned into about a 10x, 10 times multiple, because growth was so fast, it justified this price. That's what that means. Now, this has fallen over time. It's now 45 times. The company itself is much, much bigger, so it's still expecting rapid growth from this point. Now the business is $287 billion of enterprise value. It's generating $6.4 billion of annual cash flow. And they're saying from this point, we expect rapid growth such that the current market, people are willing to pay 45 times earnings for this business. Now, question is it justified? We're gonna figure that out right now. Let's go to the cash flow statement. Cash flow statement, your favorite statement, my favorite statement, the cash flow statement. All right, let's do this. Let's figure out cash flow. So here we go. 2013, $98 million. It has grown very, very slightly to $393 million with several periods of negative cash flow, large negative cash flow. CFO stands for cash flow from operations. It's the first third. When you look at the cash flow statement, there are typically three bolded categories on it. The first third is the cash flow from operations. That's how much cash money, hard currency, did they keep from running the business for 12 months. The next third is the investing section. That's what they did with that cash on a long-term basis. And the third section is the financing section. That's how do they finance the business? Did they pay down debt? Did they borrow money? Did they pay investors dividends? Did they sell stock and get money in? Do they buy stock down? That's what's down in the third section. And what you're seeing here is from operating their business, they actually lose a lot of cash. Now, what's interesting here is you look at EBITDA, and EBITDA is positive and growing. Cash flow from operations is negative and getting bigger, frankly. Now, what's happening? Well, we're going to go dive into detail to figure this out. And this is one of the critical differences between EBITDA and cash flow. It's why Warren Buffett and Charlie Munger don't like EBITDA, is it hides costs. I use it here as a relative value, but we always build a forecast based on cash flow. I'm going to show you exactly why. Go to Netflix website, go to the investor relations sections, and you can download this Excel sheet, which is their financials for the Q4 2021, and it gives you both the income statement, the balance sheet, and cash flow by quarter. I'm highlighting here the 12 months ending as of December 31st, 2021, because I want to show you a critical difference between EBITDA and cash flow. And it's right here. Additions to content and amortization of content. This is a very, very big difference. What did I say in the beginning? I said that what they do is they invest in content, they make a show, and that has the salaries, it has rental of location, it has the food cart, it has the makeup people, and they put it on the balance sheet, and they expense it over a period of time. That expensing over a period of time is amortization, $12 billion for content that they have made in the past and they're expensing every month. That's what hits the income statement. When you look at the income statement, they're expensing this number, okay? And if you use EBITDA as a traditional method where you add back all depreciation and amortization, you'll add back the $12 billion. Now, what are they actually doing? Well, this is a non-cash expense because they spent the cash many, many years ago. But this period, this year, what do they have to do? Additions to content, $17.7 billion. So this is, in 2021, the content that they made this year, the cash money that they paid for actors, food carts, trucks, rental equipment, TV series, all that stuff, $17 billion. So what's the takeaway here? Takeaway here is they're showing on the income statement $12 billion expense, but they're actually spending in cash $17.7 billion. So when I go to my EBITDA here, which I'm expensing only the amortization piece that's on the income statement, this is too low. This is too high. This number is missing an extra $5 billion of cash money that they actually spent. That's why EBITDA is positive and cash flow is negative. Now what do we do? Now that you understand the difference between earnings on the P&L and cash flow that they make, let's keep going, finish the cash flow statement. I'm going to show you how we forecast this going forward. Next is CAPEX. CAPEX is just what they put into the property, plant, and equipment, which is the depreciation, the D in the EBITDA that I have added back. So I'm expensing the cash here to be fair and in line. Going forward, I've got net debt. That's the borrowing and the payment of debt. That's in the lower third of the cash flow statement. If I go back to the cash flow statement, you can see it right here. Debt issuance cost, repayment, proceeds from issuing common stock, purchase of common stock. So they issued debt last year. I've got them they paid down debt last year, $500 billion. That was on the cash flow statement. But when they were burning cash, historically, what are they doing? They're borrowing the money. So this free cash flow to equity is artificially high because they're borrowing the money. They can't actually afford to, they're choosing to finance it. They could pay all cash for their content generation, but they are financing a portion of it. I think the point here is that the free cash flow is a whole lot less than the income statement is reporting that they actually make. So let's focus on a particular year. Last year, 2021, they made $393 million of cash flow from operations. That's not a whole lot. In fact, if they're representing earnings of $6.4 billion, what they made in cash was $393 million. After this, they have to put money back into their property, plant, and equipment. So that's buildings, that's infrastructure. They had to put $525 billion back in. That's a negative number. So now they're cash out for the year. They had to pay debt service. They had to pay down their debt $500 million. So grand total, if I add all this stuff up, they reduced their cash by $632 million. In terms of shares outstanding, they have 455 million shares outstanding. That share count is growing. We want the opposite. We want to see shares shrinking, but they're printing shares to generate cash to help fund the losses, the content that they're producing. I then take free cash, divide these two, total cash flow for the equity holders, divide by shares, I get cash flow per share. It's negative because they put money into the business. Here is the price per share, and there's a cash flow yield. The lesson here is they make very, very little actual cash. They are a growth stock. If the growth continues, the value stays up. They also shield some of the true costs of their business by capitalizing, which is totally legal. Capitalizing, so the income statement, when people look at earnings per share, it's missing $5 billion of costs that they actually had to pay. So now what do? Let's forecast. All right, let's forecast Netflix. Now we want to create a forecast that is likely to happen, something that's conservative, because anything we buy, we're buying this forecast. We're basically saying that we're going to put our money that this forecast will happen. So we want to pull a conservative number. Here's their sale forecast. I've simply copied the historical actuals right behind me, and then built a forecast down below in blue. And what I want to show you is this right here. In the last several years, growth for Netflix has been coming down. Fiscal year sales growth rate, 26% year-over-year growth rate, fantastic. 23, 30, 32, 35, amazing. Now watch, 28, 24, 29. It's decelerating. And I think you're going to see, you saw that rather with their earnings statement where subscriber growth was less than they thought. If I do the change month to month here, that's what this is. Me just saying, hey, what is growth rate actually doing? And the growth rate has actually decelerated the last 3 years in a row. And I think that's because content in general is everywhere. You know, if you rewind the clock 8 years ago, Netflix was kind of the only player in the game. But now you have Disney Plus, you have Hulu, you have Peacock, you have HBO, you've got Amazon in there, you've got everybody. And I think we're in a content bubble. I mean, heck, you're watching YouTube, you're watching me right now. That's content that I'm making in my backyard for free. I mean, it's a hobby of mine, but yet it's taking up your time. You're not watching Netflix. So I think we're in a content bubble. There's so much content out there that people are realizing they don't have time to watch Netflix, and they're unsubscribing, or they're subscribing at a lower rate. I mean, you can only have so many subscribers in the world for any service. So what I've done is I said their growth rate's going to come down. And I do believe that they can only get so big with content. And so to be prudent, I'm going to say that their content growth rate is going to decline and then stabilize at a 5% annual growth rate. So I'm still growing revenue, mind you. I'm not saying revenue is going to shrink. I think revenue will continue to grow for them, period, full stop. But the growth rate is not going to be double digits. The growth rate is not going to be high 20s. I'm saying it's going to be mid-single digit growth. Okay, that's what I'm willing to put my money against. I'm not willing to pay for 20% growth for the next decade. So then that means they grow from $33 billion to about 56 billion dollars. Okay, now I've got a revenue forecast. And what I do from here is I'm going to assume, I'll go back to the top so you can see, I brought in the actual EBITDAs and I looked at the EBITDA margin. EBITDA margin grew to 22%, again, because they're hiding some of the costs from the income statement versus the cash flow statement. So I'm going to take 20%, I'll say they're going to have a 20% EBITDA rate going forward. Okay, now I have a revenue forecast and I have an EBITDA forecast. The trick is, how do we deal with the content? So what I did is I looked historically for the last 9 years, how much have they amortized in content? And how much cash money every year did they have to put into content? And what's the difference? Basically, right-sizing the P&L, make the P&L look like the cash flow statement. And what that does is it says every single year, the income statement, the P&L, the income statement for Netflix is missing these expenses in cash. And so I said, okay, if I looked at EBITDA, and I think it's roughly 76% of EBITDA is what they're missing to put out, right? They claim that they made $6 billion of EBITDA, but really, and cash flow from operations, it was like 300 and change. Well, that's almost 80% of the EBITDA, 90%. I said it's about $76 billion, 76% of EBITDA is overstated and missing the cash they need to put out. So I think going forward, they're going to put another $5 to $6 billion every year in content just to maintain the interest level from their subscribers. Otherwise, they're going to go someplace else. That's a big cash cost, and it creates a big divide between EBITDA and cash money, which is what we use. So then I carry that forward. I said, okay, I take EBITDA and I less this $5 billion. I get a much lower cash flow from operations, CFO. I add a little bit of CAPEX. And I assume that no debt's going to change because they don't really have too much debt. They can maintain it. I sum it up, and sorry, you can't see the column totals here, but I sum it up for free cash flow for the equity holders, and I divide it on a per share basis, assuming no further dilution, and I get a cash flow per share forecast. Okay, now let's summarize the forecast. So you saw how I built up EBITDA. 5% revenue growth, 20% EBITDA margin gives me $7.6 billion up to $10 billion. Here's my growth rate. Over time, I think the enterprise value to EBITDA multiple is going to come down. If growth falls, the multiple is going to come down. So I think it's going to have a 12x multiple. Much more moderate growth. You think of like Disney or something that's big and stable, has content that just cranks along. Well, its multiple is much, much lower than 45 times of Netflix. And that multiple falling is going to depress and bring down the share price, or rather it's going to limit the growth rate of the share price. So 12 times 10 is $128 billion enterprise value, less a little debt, plus some cash, gives me $111 million of market cap. If I divide it by the share count, which they're continuing to issue shares to fund all this stuff, I divide it by 455 million shares, I get $244 on a share price for Netflix based on an enterprise value EBITDA multiple. Let's check out free cash flow where the rubber meets the road. Okay, our free cash flow method. Remember, I took the difference between EBITDA and the content that they have to put down, that extra $5 billion every year that they have to put into the business just to maintain the content they have, to maintain the subscribers that they want to. And what that does is it dramatically lowers the cash that's available for cash flow per share, which underlies the value of the business. And what that does is it takes my cash $2.39 to $4.26 out 10 years. I apply a 4% free cash multiple to that, which might be a little low. I mean, honestly, I require 5 or 6, but but that make this number even lower. What this is saying is I have a $106 price target for Netflix out 10 years based on the free cash flow method, which is the underlying value of any business. Okay, now, we just went through a lot, and what I do is I make a one-pager that summarizes both the historical financials, the forecast, and the IRR, which is coming up next. If you want to see this, join the Cash Flow Club. I talk about a lot of other stocks, not just the ones that I release weekly, but a whole host of other stocks that I think are both good, bad, and ugly. All right, now we have two values for Netflix. I have one based on the enterprise value to EBITDA multiple, and I have another based on the free cash flow method, right? So what I can do, free cash flow method, $106, enterprise value measured $244. I'm going to split the difference because I don't know which one the market's going to rely on. And I'll say $175, my long-term price target for Netflix. Now what we're going to do is we're going to put this into an IRR model. You've got the years and the free cash flow. This free cash flow is your percentage ownership of the cash. It's not the dividend that you would receive, but it's free cash from the business, which is the underlying value. Now, the company itself could dividend this out. It could use it to buy back shares. It could sit in the balance sheet, or it can use it to acquire or grow the business. Those are the four uses of this cash. But either way, it's your incremental ownership based on the share count. So I can buy as many shares as I want right now in the market for $380 a share. If I do that, I'm going to own this forecasted stream based on some conservative numbers of what I think might happen in the future. And then in the end, if I value it on its cash flow, I get $175 of value. That is not a great investment at all. I sell it for less than what I bought it for. That says it's going to yield a negative 7% return based on this kind of slow growth pattern that we're seeing over the last 3 years. And that says it's a negative 7% IRR, which is definitely not a well-priced stock. Let's review our 5 key attributes. Number 1, top-line revenue growth. Yes, it has been growing, and we're continuing to expect it to grow. We'll check that box. EBITDA. EBITDA is strong and it's positive. It's growing. We'll check the box. Cash flow. No, it's not. Cash flow does not line up with EBITDA. They have to put too much money into the content. We're not going to check that box. It's not strong. Low debt. Yes, debt is 2 times low. And well priced. No, I don't think so. I don't think the stock is cheap enough given how little cash it actually generates. So what ranking are we going to give this stock? What are we going to do? We're going to do a bad. We're not buying this stock. Why? As I discussed, it does not generate cash flow. Cash flow is the underlying value of any enterprise. We are rational, cash flow seeking, long-term investors, and we buy cash flow. We cannot justify this investment. So we're going to pass. Thank you very much. Let's take a look at a distribution. If we were to buy the stock, what price would we need to justify the stock purchase? So here's a quick sensitivity table. $380 the current stock price with the negative 7% IRR based on the forecast that we have, which is a conservative one, I'll grant you that. But it's our money that we're putting to work. I'm not willing to risk my money. If the stock price goes up, then the return goes down, right? Because you're not getting any better of a forecast. The stock price has to come down considerably. I would say in 150 range for you to be really interested before buying the stock. So I think you're going to steer clear of this one for a long time. If you liked what you saw, the Excel file, the historical financials that give you a 10-year look, building a forecast, putting in an IRR and some sensitivity tables, I teach a course, and I highly recommend you go to cashflowinvestingpro.com. You can sign up for my cash flow course. I will give you this Excel model. I will show you 10 Ks for Apple, and I'll walk you through how I value Apple stock and teach you to do this. There are over 3,000 stocks in the public market in the US alone. You can value many more of them, and there are deals out there you can find that analysts aren't covered because there's simply too many stocks to cover. Now, if that's too much work, I do have a cash flow club where monthly I release multiple one-pagers for many more stocks than I can cover here this channel doing it once a week. It's complete one page that synthesizes everything I just discussed. You have 10 years of historical financials, you've got cash flow and EBITDA forecasts, you've got a chart of the stock, and you've got a summary of my analysis of why I think the stock is good or bad. That's the Cash Flow Club. Check that out. The people are diving in there all the time, and I greatly appreciate it. Coming up next, check out videos that are going to pop up on the screen for more highly discounted stocks to learn more on how to value companies. Click the videos on the left or right to find more. Lastly, I want to thank all the subscribers and commenters to the channel. If you like what you saw, please subscribe, like, and comment. Helps me out. It's a hobby of mine, but I do doing this channel, but I really appreciate all the support, and I really enjoy it. Here's some comments from fans, subscribers that saw the last videos that really liked. Jordan said, "You are a stud of the people." Thanks, Jordan. Really appreciate that. Holistic Hottie, great name, by the way. Your videos are great. Thanks, Hottie. Appreciate that one. And then Thomas T. I'm a first-time viewer. Excellent analysis with comprehensive data. Just subscribed. Thanks, Thomas. Really appreciate that one. Go ahead and hit the subscribe button. Like, throw a comment down below. Let me know what stocks you'd like to see in the future. I'd be happy to go through them. Once again, thank you very much. I greatly appreciate it. I hope you're having a wonderful 2022. The stock market's crazy, and if you're hunting and value, you're finding deals out there. So keep diving through the data, keep picking through stocks, buy, hold, don't sell, and live well. Thanks, guys. Take care. Bye-bye.